Hey, bulls and bears, and welcome to today's report. We're going to get back into the housing market today. Many people call this housing bubble 2.0. Also, many people are saying this is housing bubble bust 2.0 as the housing market is coming down and correcting. Home prices are coming down. Now, a lot of this housing market information is playing out pretty close to how I expected it, how I think most of us expected it, but there's a few surprises. We're going to talk about foreclosures today. We're going to talk about the plunge in mortgage refinancing, no surprise there. And we're going to look at some of the biggest housing markets, or some of the markets with the biggest price corrections so far, and what may be ahead for us in the housing market. Let's go ahead and get started. Now, first of all, let's talk about home sales. Home sales are down 35% year over year. 35% is a big number. Unfortunately, for people waiting to buy a home, home prices are not coming down quite as quickly as sales. But as sales decline and drop, typically home prices follow. So this year in 2023, will we see declines in home prices of 35%? Well, if mortgage rates stay where they're at or go higher, it's definitely likely. But something interesting that's happened here just in the past few months, mortgage rates have dropped, but so far it has not really breathed much new life into the housing market. Now let me move myself way up here to the far right so you can see this chart. This is mortgage rates here just recently, closer down to about 6%. They were hovering up around 7% and higher for a brief period in late 2022. So still way above where we were, which was in the mid 3.5% range or mid 3% range back at the beginning of 2022. And it's pretty interesting. We have the Fed out there basically saying they want to bring prices down or bring the cost of living down or bring inflation down, but yet they're still out there buying mortgage-backed securities and trying to suppress mortgage rates. If they would just let mortgage rates rise, then we would truly see a big correction and maybe even a crash in the housing market. But as I predicted here, I do not think the powers that be are going to let the market crash. But I do still see price declines ahead of us in the year 2023. Now, we just looked at how mortgage rates have dropped almost a full percentage point from the peaks that we saw last fall and at the end of 2022. But look at mortgage refinancing. Mortgage refinancing hasn't really jumped back up. And in fact, if you look to the far right here, we see that we're at the lowest in over 6 years. And this is what we refer to here as the lifeline for many U.S. homeowners. Without the ability to continually refinance at a lower rate, a lot of homeowners are in big trouble. So you would think that foreclosures would begin to increase. Well, they are increasing in some places, but it's still very low from historic standards or from historic normal, including before the previous housing bust. And we're going to talk about that here in just a few minutes, and we'll also give you the reasons why. Now let's bring up another chart here. This is another chart out of Wolf Street, and Wolf Street sourced this from the New York Fed, but go visit Wolf Street's website. Very nice website. Frequent updates on the housing market and a lot more. And we really appreciate them putting out these charts. But look here, these are the delinquencies 30 days late or more for mortgages and HELOCs. That's home equity lines of credit. And we see that we're actually lower now than we were. Well, actually a little bit higher, but lower than we were at the lowest before the housing bubble one, I guess you'd call it housing bubble one, 2006, 2007, 2008. We're below where we were at the lowest point back then, but we're actually rising. If you look to the far right here, we are now ticking up on these 30-day late mortgages. Now, why did it drop so low after 2020? Well, most of us know here what happened. The economy got put on artificial life support, including the housing market. People couldn't get their homes foreclosed, and we had all of the artificial stimulus and paycheck protection programs, stimulus checks that went out, cancellation of rent, and foreclosures, you name it. It was a completely artificially propped up economy. Otherwise, we would have witnessed the biggest plunge in the housing market that we've ever seen, and I think a lot of different things would have deflated instead of inflated, including automobiles. Now, automobiles, we had the big supply chain disruptions, right? But all the money creation really propped up these markets, in my opinion. And I think even with the supply chain disruptions that we saw, that prices would have came down if it were not for all the intervention, artificial stimulus, and prevention programs that were implemented in 20. So if the recent drop in mortgage rates over the past few months, like we saw in the chart just a few minutes ago, didn't stop these delinquencies from rising, what will stop it? Will we have to see mortgage rates plunge back down to 4 and 3.5% like we did just over a year ago? Well, that looks to be the case because even with lower mortgage rates, delinquencies are still rising. Now they're still low, but this is looking like it looked back here in housing bubble 1.0, right around 2006 going into 2007 when we started seeing delinquencies increase for both mortgages and home equity lines of credit. And how many people think that if mortgage rates stay high or go higher, we could see something similar to what we saw in housing bubble 1.0 with the increase in late mortgages and home equity lines of credit, or maybe even worse, maybe even a much steeper increase? Or will it be much slower because they're going to keep mortgage rates artificially suppressed? Or something completely bonkers, the Fed completely pivots, cuts the Fed funds rate, and pushes mortgage rates lower, even lower than they were before. And then what you'll see is the delinquencies drop and the housing market recover, home prices start shooting back up. And folks, in a manipulated market like this, anything's possible, but I tend to lean on the side of delinquencies will continue to rise. The Fed cutting rates right now, or pivoting as a lot of people call it, would be a disaster for them because of all the pain right now out there in the economy. People are really noticing and pointing the finger at the money guys, if you know what I mean. Now let's take a look at the cities with the biggest home price drops so far. And these are from the peaks, which were the all-time highs. Most of these cities, the all-time highs were at the beginning or mid 2022. And this is another line of data that I pulled out of Wolf Street. Also, Wolf Street, Wolf Richter has a YouTube channel, so please check his channel out as well, right here on YouTube. But here are the biggest drops here. San Francisco Bay Area down 13%, Seattle down 12.2%, San Diego down 8.5% from the peak, Denver 6.7%, Greater Los Angeles 6.6%, Phoenix metropolitan area down 5.9%, Dallas Metro down 5.6%, Las Vegas Metro down 5.2%, Metro being those cities and the surrounding areas. Now, if you just single out San Francisco, separate from the entire Bay Area, home prices are down even more. In fact, home prices are down about 27% from the peak. And the pain in the San Francisco housing market was exacerbated by all the tech layoffs in that particular area. Now, here's one of the big reasons why delinquencies in the housing market and foreclosures have not spiked higher and faster than they have already. And many economic people that I see and watch, do not mention this, and I'm not sure why. And this is the home ownership rate. Take a look at before housing bubble 1.0, 2006, 7, 8. Take a look before that bust. Home ownership was up at about 69%, almost 70%. And look what happened. Home ownership dropped after that. But look where we are now. Even now at the peak in 2020, when many people went out and bought homes, we're still under 68%. Home ownership since then has dropped some and is beginning to tick back up here over the past couple months. But we're way below where we were before the previous housing bubble went bust. We're way below that now here in 2023. Why? Because more big money owns homes now, more institutional investors. The BlackRocks, the Blackstones, the Invitation Homes, etc. Right? So when was the last time when you heard about Blackstone getting foreclosed because they couldn't make their mortgage payment. Well, that's because they don't have a mortgage payment because they went out and paid cash for homes. And if they do get in any sort of trouble, what can they do? They can raise their rents on tens of thousands of tenants. Well, things may be starting to change there as well, because as we know, if you've been on this channel, you know that rents are dropping, and rents dropped for the last 4 months of 2022. And those drops were the biggest that we have seen in over 5 years. So the rental market, or the housing rental market, is also starting to change and correct to the downside. Now, if we see some of these big investment companies that bought so many homes, if we see them start getting in trouble, then we're going to see a lot of inventory come onto the market because, again, they went out and bought so many homes after the last housing bust. And it's interesting to think about it and imagine how much lower home prices would have went if it were not for all the institutional buyers and the big money that was waiting on the sideline. Now let's take a look at inventory here. Now let's take a look at the housing market supply. This is the number of homes for sale. This is out of Redfin. And we see as of December, at the end of December, the last year of 2022, we're at about 1.3 million. And that's actually still higher than what it was at the end of 2021, but still lower than we were going into 2020. So again, we're not seeing that big spike in inventory that many people out there had predicted. And we go out to a 5-year chart here. We go back to 2018 and 2019 when the Fed started raising rates. Of course, they cut again after that, but the Fed started raising rates back then, and the number of homes for sale went up to about 2.3 million. So we're about a million below where we were at those heights back in 2018 and 2019. So folks, we're going to wrap this one up, and it continues to amaze me how many people were totally wrong about the housing market. People said home prices were going to crash, but you have to look at a lot of different things, right? So come back to this channel. We talk about not just prices and interest rates or mortgage rates. We talk about a lot more: inventory, institutional buyers, of course, consumers being tapped out, home equity lines of credit, the job market, the labor situation. You've got to factor everything in to really figure out what's happening and how to prepare for this economic situation. So everybody, hope you guys like this. Please let me know what you're seeing down in your neighborhood. Are you seeing price corrections? Are you seeing a lot of for sale signs on the street corners in your neck of the woods? Please let me know. Otherwise, we'll talk to everybody very soon. We hope to see you back here for our next report. Big love. Bye for now. Keep stacking and